Have you ever noticed how, when you finally get ahead financially, the system gently nudges you to slow down? You receive a raise, your savings grow, and for the first time you think, what if I just pay off my mortgage early and be done with it? It sounds responsible, even freeing, but the financial system isn't designed to reward that decision. Consider a typical scenario in the United States or Western Europe. A couple in their early 30s earns a combined $85,000 after taxes. Their monthly mortgage is $1,700. Car payments, $450. Student loans, $300. Insurance, utilities, groceries, subscriptions, another $1,800. At the end of the month, they manage to save about $600. After a few disciplined years, their savings reach $40,000. They start thinking about making a large extra payment toward the mortgage. It feels like progress, like control. But here's the quiet truth. A 30-year mortgage is one of the most profitable financial products a bank can issue. Take a $300,000 mortgage at 6.5%. Over 30 years, the total interest paid is roughly $382,000. That means the bank earns more in interest than the home's original price. If the homeowner aggressively pays it off in 15 years instead, the interest drops to around $171,000. From the borrower's perspective, that's a victory. From the bank's perspective, it's lost revenue. This is why early payoff options are rarely promoted. Instead, you're offered refinancing, cash-out equity loans, or home equity lines of credit, products that extend debt and generate new interest streams. But the math alone doesn't explain why most people don't pay off their mortgage early. The deeper reason is psychological. A low, fixed monthly payment feels manageable. It blends into life. Sending an extra $1,000 toward principal, however, feels like losing liquidity. The money disappears into the walls of a house you already live in. Humans prefer visible cash over invisible equity. There's also social pressure. Friends upgrade kitchens, neighbors buy newer cars, vacations appear on social feeds. Extra mortgage payments don't produce visible status, so the payment schedule continues, quietly stretching across decades. If ignored, the long-term impact is subtle but significant. 30 years of interest payments delay retirement flexibility. They increase financial stress during job transitions, and they keep a large portion of lifetime income tied to past borrowing decisions. Financially intelligent households don't view this as a moral issue or a race to zero debt. They view it as a trade-off. They understand that every extra dollar paid toward principal is a guaranteed return equal to the mortgage interest rate. They weigh that against liquidity, investments, and risk tolerance. Some accelerate payments, others invest the difference. The key difference is awareness, not urgency. Because the goal isn't to eliminate debt as quickly as possible. The goal is to understand the system you're operating inside and make decisions consciously rather than by default. If this perspective helped you see your mortgage in a new light, consider subscribing for more calm, reality-based insights into how money actually works.